Hey traders, welcome back to our channel. Today, we're diving into the fascinating world of smart money concepts, exploring the best trading setups that can elevate your trading game from beginner to pro. We'll start with some fundamental setups that are perfect for beginners, and gradually move to more advanced techniques used by professional traders. By the end of this video, you'll have a comprehensive understanding of various setups that can help you navigate the market with confidence. But before we dive in, don't forget to like this video and subscribe to the channel. Let's jump in. When it comes to identifying a strong trading setup, many factors and confluences need to align. A typical beginner setup usually looks like this. First, they identify a clear order block and a fair value gap, then they spot a break of structure. At this point, they execute their buy orders with a target above the swing high. These are the primary confirmations that most beginner traders rely on for their setups. However, if you still rely solely on these basic factors, it means you have a lot more to learn in your trading journey. Remember this crucial rule: the easiest setups are the ones most traders go for. This high trading activity generates liquidity, and institutional traders often drive the market against these positions to access this liquidity through stop losses. So, let's take this basic setup and evolve it into a much more advanced one. Stick around until the end because this video is going to revolutionize your trading game. Let's get started. We'll start with simple concepts that can elevate your trading game from a beginner to an intermediate level. Then, we'll delve into advanced concepts that will take you from intermediate to advanced level. Note that these concepts are not meant to be applied separately but should be used together as confluences to increase the win rate of your setups. That's exactly what we are going to teach you today. We will start with concepts for intermediate traders. Remember, to reach an advanced trading level, you need to master the minor concepts first and then work your way up to the major ones. These three concepts may seem simple to most beginner traders, but they hold great value. Let's dive into each one in depth, starting with the importance of the location of your setup along the trend. In this uptrend, the price has presented us with 4 setups for potential buying opportunities. Can you rank these setups from the safest to the least safe setup to buy from? Pause the video and try to think about it. Most traders don't consider how long the trend has been progressing upwards. They see a good buying opportunity and jump in, which is why many end up losing their capital. In trading, there's a crucial concept called market exhaustion. Understanding this concept helps us determine when it's safe to execute trades and when it's better to stay away from the market. In this setup, we just had a change in market character indicating a trend reversal. At the start of an uptrend, there are more buyers entering the market, meaning bullish momentum is at its peak. When there are more buyers in the market, it becomes safer to buy, making this the safest setup. However, as the price progresses upwards, by the time it reaches this setup, there are fewer buyers in the market, meaning bullish momentum is at its lowest. With fewer buyers, it becomes unsafe to look for further buying opportunities, making this the least safe setup. To compensate for this decrease in bullish momentum as the market pushes higher, you can afford to risk more at the start of the trend since it is safer to buy at this point. However, as the price continues to rise, it becomes important to risk less. Based on our research and trading experience, we can conclude that the first 3 setups are the safest for executing your trades. Beyond the third setup, the market is likely to experience exhaustion, and eventually, the price will break below the swing low, indicating a trend reversal. There are 2 key points to take note of. First, always remember that the first 3 setups along a trend are the safest for executing your trades. Secondly, beyond the third setup, the market is in a phase of exhaustion, so it's advisable to stay away from it. In this market, we've just witnessed a change in market character, signaling the beginning of a downtrend. With more sellers entering the market, bearish momentum is at its peak, making this setup safe for selling. We wait for the market to retest our supply zone, and from there, we execute our sell orders. It's highly probable that the market will respect our setup. Additionally, it's likely that price will present us with 2 more selling setups, both safe to execute. Remember, the first 3 setups are considered safe to execute and typically have a high win rate. Price has presented us with another supply zone for potential selling opportunities. However, I advise traders to stay away from this 4th setup because we are now in a phase of market exhaustion. At any time, the market can break above our swing high. Remarkably, price managed to respect this 4th setup. This marks the maximum number of setups a trend can print out. From here, market exhaustion is at its maximum, and we should start expecting a change in market character, indicating the beginning of an uptrend. This means that more buyers will enter the market, leading to bullish momentum being at its peak, making it safe to start looking for buying opportunities. So, remember that the first 3 setups in a trend are considered safe to execute your trades from. Beyond that, we enter a phase of market exhaustion and should start anticipating a change in market character. Let's look at the second concept, premium and discount pricing. Remember, these concepts are not meant to be applied separately, so we will use them together. In this example, is this a good setup to buy from? Yes, because it is the second setup since the start of the uptrend. Remember, the first 3 setups are safe to execute your trades. Our second confluence will be premium and discount pricing. To apply this tool, first identify your local swing low and high. Then, extend your Fibonacci tool from your swing low to your swing high. At the 50% level, we have the equilibrium. Above 50% is the premium price, and below 50% is the discount price. The idea is simple: in an uptrend, we only buy at the discount price. So, always ensure that your demand zone is within the discount price if you are looking for buying opportunities. We won't delve deeper into this concept here, but if you want to understand it better, there's a link in the description to a video that explains this concept in depth, so be sure to check it out. In our example, our demand zone is within the discount price, a zone where we have more buyers coming into the market. Therefore, it is very likely that the price will respect our setup. Let's look at the last concept, lower timeframe confirmation. Once you've confirmed that your setup is within the first 3 setups that are safe for executing your trades, and that it is within the discount pricing range, there's one last step to maximize your win rate. Before executing your buy orders, transition to a smaller timeframe to observe how the price reacts at our demand zone. This final confirmation helps ensure that the market conditions are favorable for your trade, further increasing the likelihood of success. On the lower timeframe, wait for the price to break above your local swing high. This indicates that the internal bearish momentum is over, and buyers are stepping into the market. Identify your lower timeframe demand zone and wait for the price to retest it. Once it does, you can safely execute your trade. We won't delve deeper into multi-timeframe analysis here. If you want to understand this crucial concept better, there's a link in the description that will take you to a video explaining multi-timeframe analysis in depth. Be sure to check it out. This is what intermediate trading looks like. Remember, all 3 concepts we covered must align before executing any trade. These 3 concepts, if applied correctly, can completely transform your trading success. Now, let's look at a price chart example where we apply all 3 concepts simultaneously. In this price chart example, we observe a change in market character, indicating the start of an uptrend. This suggests that more buyers are entering the market. Next, we identify this extreme demand zone and wait for the price to pull back and interact with it. However, before placing any trades, we need to go through our confirmation criteria. Firstly, we can see that our setup is within the first 3 setups which are considered safe to buy from. Secondly, our demand zone falls within the discount pricing range, where we typically see more buyers willing to step into the market, making it an eligible buying zone. For the final confirmation, we transition to a lower timeframe to observe how the price reacts when it reaches our demand zone. In this lower timeframe, we start by waiting for the price to take out the local swing high. This signals that the internal bearish momentum has ended. Once all our 3 confirmation criteria are met, we can proceed with our buy orders. Next, we identify a lower timeframe demand zone that must also be within the discount pricing of the internal structure. We then wait for the price to pull back and retest this demand zone. At this point, we execute our buy orders, targeting levels above the major swing high. Transitioning back to our higher timeframe, we can see that the price has reached our target. After the break above the swing high, signaling that bullish momentum is still strong, we pinpoint a demand zone and patiently wait for the price to pull back and retest it. But before we execute any trades, we must ensure our setup meets our confirmation criteria. Firstly, our setup falls within the first 3 setups, which are generally considered safer for buying opportunities. Secondly, our demand zone aligns with the discount pricing range where many traders seek buying opportunities. For the final confirmation, we transition to a lower timeframe to observe how the price reacts to our demand zone. Only when all these criteria are met do we proceed with executing our trades. In the lower timeframe, our strategy begins with patiently awaiting a break above the local swing high, signaling the end of internal bearish momentum. Following this, we identify a demand zone that must also be within the discounted price range of the internal structure. Once the price pulls back and retests our demand zone, we execute our trades with confidence, setting our targets above the major swing high. Then, we let the market unfold naturally. As anticipated, the price surged upward and successfully reached our target. By adhering to these confirmation criteria, you cultivate discipline and patience, essential qualities for any trader's toolkit. This approach teaches you to wait for setups with a high probability of success, ultimately enhancing your overall trading performance. Take the time to understand the concepts we've just covered thoroughly. Now that we've covered beginner to intermediate concepts, let's move on to the advanced level. The key concept at this stage is liquidity, which plays a crucial role in determining the outcome of our trades. Mastering this concept is essential. Under liquidity, you need to understand different types of liquidity traps and how to avoid them. Additionally, learning how to align your trades with institutional traders is vital. Mastering these concepts can significantly elevate your trading to an advanced level. These are the most common types of liquidity traps, frequently encountered because many technical traders follow these patterns. Remember the advice I gave earlier: the easiest trades attract a lot of liquidity, making them prime targets for liquidity traps set by institutional traders. To delve deeper into this topic, check out the link in the description, which will take you to a video on our channel that explains liquidity traps in detail. One thing about institutional traders is that they execute huge trades, requiring significant liquidity in the market. Over the years, they've developed simple strategies to create trading activity by manipulating retail traders. Let me show you how. Let's say institutional traders want to execute a large buy order at this demand zone. Remember, large volume trades need a lot of liquidity. To create this liquidity, they might induce a temporary price movement like this one. Technical traders see a trend line in this scenario and place their buy orders at the trend line's retest, with stop losses just below it. This cluster of stop losses generates a significant amount of liquidity, which institutional traders need. To access it, they push the market down, clearing all the stop losses below the trend line. With the increased liquidity, they execute their large orders, causing the price to shoot upward rapidly. By learning to identify these areas where liquidity is generated, you can align your trades with institutional traders, greatly increasing your trade success probability. Now, let's look at some price chart examples. In this example, if institutional traders want to execute a large buy order at this demand zone, they first create a temporary price movement like this one. Technical traders see this as a trend line and place their buy orders at the retest of the trend line, with stop losses just below it. This cluster of stop losses generates significant liquidity below the trend line. To access this liquidity, institutional traders push the price down, clearing all the stop losses below. Once the price retests the anticipated demand zone, it becomes a good buying opportunity because you have a liquidity sweep as your confirmation. However, I always teach people to exercise patience and transition to a lower timeframe to observe how the price reacts at the demand zone. This additional step helps ensure a higher probability of success. On this lower timeframe, first wait for the price to break above this local swing high. This indicates that the bearish momentum is depleted, and buyers are stepping into the market. Next, identify your lower timeframe demand zone and wait for the price to retest it. From here, you can execute your buy orders, setting your take profit above the major swing high. Transitioning back to our higher timeframe, we can see that the price respected our setup. It's crucial to master this concept of liquidity because it significantly enhances your trading accuracy. One key point to note is the fascinating risk-to-reward ratio. This is one of the benefits of lower timeframe confirmation. It ensures we do not trade against the lower timeframe trend, thereby avoiding unnecessary losses. Additionally, it reduces the capital at risk per trade while increasing the risk-to-reward ratio. A lot of people pay thousands of dollars for this information, but we decided to give it to you for free. So, please take your time and learn these concepts in depth. If you have any questions, leave them in the comments below, and we'll get back to you as soon as we can. Don't forget to like and subscribe so that you don't miss out on our future uploads. See you in the next video.